All right, picture this. You own a piece of a skyscraper, a big apartment complex, maybe even a fancy medical building, and you did it all from your laptop. No calls about clogged toilets, no chasing down rent checks. Sound like a fantasy? Well, it's not. It's called real estate crowdfunding, and it's completely shaking up how regular people like us can invest in property. So in this explainer, we're going to tear it all down and show you exactly how it works.
You know, for the longest time, getting into real estate investing felt like, well, it was a tough road. You had to save up this massive down payment, buy a place, and then get ready for the headaches. Tenants, toilets, all that fun stuff. It was a game pretty much just for the rich, right? But what if I told you that technology, and one specific law, completely smashed that old model? That's what we're digging into. So here's how we're going to break this down. First up, we'll cover the basics. What is this stuff anyway? Then we'll jump into the exciting part. The upside, how you can build some real wealth with it. After that, though, we've got to talk about the downsides, the fine print you absolutely need to know. And finally, we'll wrap it up with an investor playbook, so you can figure out if this is a good fit for your own strategy.
Okay, part one, the new landlord, you. Let's get into the basics of what real estate crowdfunding is all about. This term gets thrown around a ton, but what does it actually mean?
So, you've probably heard of sites like Kickstarter, right? Where a bunch of people throw in a few bucks to fund a cool new gadget or a movie. Well, real estate crowdfunding, or RECF, you'll hear that a lot, is basically the same idea, just, for buildings. Instead of a new watch, you're all chipping in to buy an apartment complex or a shopping center. It means you and maybe hundreds of other people can pool your cash online and own a small slice of a big, tangible property. It's a total end run around the old way of doing things, where only the super wealthy could play.
And this isn't some tiny niche thing. No way. The growth here has been absolutely explosive. The real turning point was back in 2012 with something called the Jobs Act. This piece of legislation basically blew the doors wide open for regular investors. Before this, you pretty much had to be an accredited investor, basically rich, to get in on these kinds of deals. But the Jobs Act changed all that. And just look at these numbers. From under $1.5 billion to over $14 billion in less than a decade. That just shows you how much pent-up demand there was for this.
And the way it works, it's actually pretty straightforward. Honestly, these platforms have made it almost too easy. It feels like you're shopping online. You pick a platform, browse the deals, and with a few clicks, boom, you're a real estate investor. But, and this is a huge but, that simplicity is a double-edged sword. Look at step 3 right there. Perform due diligence. I'm telling you, this is the most important step on the entire list. It is so easy to get complacent and just trust the platform. Don't. You have to do your own homework. We're going to come back to this, but seriously, your success or failure here comes down to how much research you're willing to do.
Okay, so when you go to invest, you've basically got two main choices. You can do an equity deal or you can do a debt deal. Think of it this way. With equity, you're an owner. You buy a small piece of the property. If the property does great, makes a lot of money, you get your share of the profits. Awesome, right? But if it tanks, well, you lose money. That's the risk. The other option is debt. Here, you're not an owner, you're the bank. You're lending money to the project. You get paid back in regular interest payments. It's safer, but your potential return is capped. You won't get that big home run payout. So it's a classic choice. Higher risk for higher potential reward, or lower risk for a smaller, steadier return. All right, section 2. Now we're getting to the good stuff. The upside, building wealth. So why is everyone so excited about this? What's the big appeal that's drawing so many investors in? Let's talk about it. Just look at that number, $10. Seriously, let that sink in for a second. On some of these platforms, you can get started for less than the cost of lunch. This right here is the single biggest advantage. For so long, real estate was a club you needed tens or hundreds of thousands of dollars just to get into. It was a rich person's game. But with crowdfunding, that barrier to entry has been completely demolished. It's incredible.
You know that old rule of investing? Don't put all your eggs in one basket? Well, crowdfunding makes that super easy to follow. Think about it. In the old days, if you wanted to invest in real estate, you'd probably buy one rental property in your town. All your eggs, one basket. But now, you can put a little money into an apartment building in Texas from your couch in New York. You can own a piece of an office park, a retail strip, an industrial warehouse, all at the same time. You can even invest with different developers or sponsors. It's diversification on a level that was just impossible for most people before. And what's really cool is that real estate often behaves differently from the stock market. So when stocks are going crazy, your real estate investments can act as a kind of stabilizer for your whole portfolio.
And maybe the best part of all, this is truly passive investing. Let's be real. Who actually wants to get a call at 2 a.m. about a broken pipe? Nobody.
The dream of owning property often turns into the nightmare of being a landlord. But here, you don't have to deal with any of that. The professionals, the sponsors, handle everything. Finding tenants, fixing toilets, collecting rent, that's their job. Your job is to invest and hopefully collect the returns. It's all the financial benefits of being a landlord with none of the headaches.
Okay, we've talked up all the good stuff, but now we have to get serious. It's time for a reality check. Because for all the amazing upside, there's some very, very real risks here. And if you ignore them, you can lose a lot of money. So let's get into the downside, the fine print that you absolutely have to understand before you even think about investing a single dollar.
Okay, this is probably the biggest, most important drawback, so listen up. It's called illiquidity. It's a fancy finance term, but what it means is simple. Your money is locked up. This is not like buying a stock where you can just sell it tomorrow if you change your mind. When you invest in one of these deals, your capital is tied up for the entire life of the project. We're talking 3, 5, 10 years, sometimes even longer. You can't just pull it out if you need cash. It's gone. So you have to be 100% sure you won't need that money for anything else for a very long time.
And remember that truly passive part we were so excited about? Well, that's the double-edged sword. Being a hands-off investor is great when things are going well, but it also means you have zero control. Zero. The sponsor is making all the big decisions: when to renovate, how much to charge for rent, when to sell the property. And if you think they're mismanaging the project or making bad calls, there's really nothing you can do about it. You're just a passenger on their bus, and you have to hope they're a good driver.
Another thing you've got to watch out for: fees. They can really eat away at your returns if you're not careful. You'll have platform fees just for using the website, then the sponsor takes their cut, fees for buying the property, managing it, and selling it, and then you've got this thing called the promote. Basically, after the investors get a certain preferred return, say 8%, the sponsor gets a huge slice of any profits above that, like 20 or 30%. Now that can align their interests with yours, which is good, but you have to read the fine print and understand just how much of the profit is actually going to end up in your pocket. So really, when you invest in one of these deals, you're making two big bets. First, you're betting on the sponsor. This is huge. You could have the best property in the world, but if the person running the show is incompetent or worse, dishonest, your investment is toast. You have to investigate them thoroughly. What's their track record? Have they been through a recession before? The second bet is on the market itself. A great sponsor can still lose money in a bad economy. If a recession hits, rents can fall, vacancies can rise, and property values can plummet. You can't control the market, and that's a risk you have to accept.
Oh, and one last little thing to worry about: taxes. Yep, this is a fun one. If you invest in stocks, you get a simple little 1099 form. Easy peasy. With crowdfunding, for each investment, you'll likely get something called a Schedule K-1. And let me tell you, these things are complicated. They also have a nasty habit of showing up really late, like in March or April, so you'll probably have to file a tax extension. And if you invested in deals in 5 different states, guess what? You might have to file taxes in all 5 of those states. It can become a real administrative nightmare fast.
Okay, so we've seen the good, we've seen the bad. What now? How do you actually navigate this world? Let's build your investor playbook.
This table is a great way to see where crowdfunding fits in. You've got direct ownership, buying a house yourself, over here. That gives you full control, but it costs a ton of money and it's not easy to sell. Then way over on the other side, you have public REITs. Think of these like stocks for real estate. They're super liquid, you can buy and sell them any day, but you have zero control. Real estate crowdfunding slots right in between those two. It has a super low minimum investment, like a REIT, but it's very illiquid, like direct ownership. You have no control, but you also have these high layered fees to watch out for. It really is its own unique beast. Now this is important. You need to know what kind of investor you are in the eyes of the law. There are 2 main types: accredited and non-accredited. To be accredited, you have to meet certain high income or net worth thresholds. Basically, you got to be rich. Those investors get access to the widest variety of deals. But for everyone else, the non-accredited investors, you can still participate thanks to those regulations we talked about. The key difference is that the deals available to you have gone through more government scrutiny, which offers you a little bit more protection.
Okay, if there's one thing you remember from this entire explainer, make it this: the platform's convenience does not replace your responsibility. You have to do your own homework. That means digging into the platform itself. Is it reputable? Then you have to grill the sponsor. Have they done this before? Have they survived a downturn? And most importantly, how much of their own money is in this deal? That's called skin in the game, and it's a huge deal. It means their interests are aligned with yours. And finally, look at the deal itself. Are the numbers they're projecting even remotely realistic? If something feels off, it probably is. Don't invest a penny until you're comfortable. So, what's the bottom line? Real estate crowdfunding is an incredible tool. It gives everyday people access to investments that were once impossible to get into. But it is not a free lunch. It demands a high tolerance for risk, and you have to be totally okay with locking up your money for a long, long time. This isn't a get-rich-quick scheme. It's for the patient investor who is willing to put in the effort.
At the end of the day, crowdfunding has transformed the game. It's opened up a whole new world. But the real question isn't, is this a good investment? The real question is it a good investment for you? Does it fit your financial goals, your timeline, your tolerance for risk? Is your portfolio truly ready for the long game? That's something only you can decide. Thanks for joining me.